welcome to this week's series of Credent Connect. And today we're going to cover a little bit of the market recap here for the month of May. I'm Edison Byzyka, Chief Investment Officer here at Credent Wealth, joined as always by Alisha Norris, our Senior Portfolio Manager. And we're really excited to share some of the events that transpired here in the month of May, not only as it relates to benefits across portfolios and how things materialize from a total return standpoint, but also really focusing on the true fundamentals of the economy, the markets, and most importantly, the consumer, in addition to touching on a little bit of the geopolitical structures that have taken place and how that has impacted things like inflation, things like consumer sentiment, with the potential of a truce. So Alisha, without further ado, I'm going to share my screen here. For those of you that have seen this in the past, this is a relatively new format where we do like to actually showcase the underlying data of what the Investment Policy Committee looks at, how we talk about certain topics, how we think about certain things, and how we actually put some of the analysis into fruition. And with that, what you're seeing on your screen here is a chart similar to previous segments, where we simply like to look at the year-to-date return profiles of some of the major indices. Here in this case, we have international indices, we have our S&P 500 large cap indices, mid cap and small cap. The numbers on the far right are percentage returns, right? So that purple line there, being the S&P small cap index, is up 15.5% through the end of May. The reason this chart is significant, right, in its simplistic nature, just simply showing return profiles. If you look at that red dotted line there at the 0 mark, just 2 months ago, the narrative and the structure and the rhetoric about the markets in general, following the geopolitical tensions with Iran, following some of the expected slowdown in the labor market that never really materialized, the conversations were drastically different, more dismal, more downbeat, more political in nature. Now they have shifted completely 180 degrees in just a 2-month time frame, right? Which we joke around that this is actually a great chart showcasing the benefits of not timing the market or even attempting to go that way. Alisha, one of the very interesting things in this chart that I want you to maybe elaborate on for us, please, is the fact that we're seeing the S&P 500 performing worse, right? If 11% can be dubbed as worse, but performing worse than something like the small cap index or the mid cap index. Why is that significant, especially over the past 2 months as we've seen this relative rally to the upside?
Yeah, so I think one of the things that our clients are probably wondering is how are those mid and small cap stocks doing so well during a period of volatility due to geopolitics? And it is true that mid and small caps, they have done really well. Going back to March, right, where we were talking about that dip in the market, we've really seen this risk on rally since that, about the end of March onto this year, year to date. So what that really means is just making sure that we are positioned to be diversified at all times and really taking that long-term view of markets and making sure that we're diversified to take advantage of some of this risk on rally that we're seeing. Small and mid-cap stocks are really benefiting over the last 2 months.
For sure. And for those of you that maybe are less familiar with small cap and mid cap stocks, think of those companies that derive the vast majority of their revenue from U.S. sources, U.S. consumers, right? Not as multinational, not as impacted as much by global infrastructure. Therefore, that's a huge testament to kind of how that's materializing here year to date. On that note, right, to continue with these gains through year end potentially, right, what is the probability of that happening? One of the things that we discuss is assessing what is the probability of a sustained earnings backdrop of these underlying companies and what can drive that. And one of the main things that drives that is the labor market, not necessarily just how the labor market has done, but also what is the sentiment backdrop of the labor market, right? Sentiment actually drives way more returns than actual results across capital markets, which is why you should never time the market. What we're seeing here is data from the Conference Board, Consumer Conference Board, a very respected agency that tracks surveys, that looks at broad sentiment expectations of surveying people that say, hey, are jobs hard to get or are jobs plentiful, right? So that white line there is the percentage of respondents that say jobs are plentiful, and the blue line is the respondents' percentage that say jobs are hard to get. And as you can see, there's these little shark bites that happen over time, right? We have dubbed this the often forgettable labor market cycle because it is forgettable because those shark bites happen all the time. What's critical here is the slope, meaning the rate of change, the pace of those that are saying jobs are hard to get is very healthy relative to previous cycles. Alisha, walk us through a little bit on those non-farm payrolls, just year to date alone, how those stand, and what was the backdrop that we came from even from a non-farm payroll structure just maybe even 12, 24 months ago?
So on the labor front, on non-farm payrolls, what we're seeing year to date is around 100,000 or so on average of new added jobs in the first 4 or 5 months of the year. I think that's important that we're still creating new jobs, but not nearly as an exuberant pace as we saw during COVID. So when we look at this chart that you have on the screen too, you can see that the jobs that were plentiful really shot up during COVID, and we were creating a lot of jobs and people felt really good about it. Now we're starting to see more of that neutrality within the labor market, but by no means are we seeing any real cracks. This is one of the pieces that we talked about during our view of 2026 that was really just saying that the labor market isn't as exuberant as it was, but it's really holding up really well. And this sentiment data, as well as the non-farm payroll data, is really proving that so far year to date.
It kind of reminds me of economists and analysts during COVID, when everybody thought they had the answer of what was going to transpire. At the beginning of this, and everybody was wrong, right? Things turned out to be notably more optimistic than pessimistic. But at the beginning of this year, there was a lot of rhetoric, a lot of confident, quote unquote, rhetoric that the labor market was going to derail because of so much strength and so on and so forth. That did not actually materialize. And although the 100,000 of non-farm payrolls of new jobs per month is certainly not exuberant, I think we can agree to that. It is significantly exciting to see that number given the backdrop of where the labor market came from and how many jobs were created post-COVID. As we think about this on a forward-looking basis, right, one of the things to assess is what is the sustainability of this and when are jobs going to be hard to get that will surpass the percentage of jobs that are plentiful. It is going to happen, right? This is a business cycle discussion. These shark bites happen all the time, and we should expect that to happen. Timing that is the worst possible idea, right? One of the ways we look at that, and one of the charts are created here to showcase a different angle of this, is tracking what's called credit conditions, right? Credit means borrowing. Businesses need to borrow money to be able to grow, to be able to expand, to be able to do a lot of things. And small businesses in America are a much better indicator of that than any large corporation, right? Large companies are always in the news, hiring, firing, layoffs, big hires, big changes, great. Small businesses, those less than 500 employees, are the biggest driver of sentiment. And data from the National Federation of Independent Businesses tracks this index you're seeing here. And think of the zero baseline as the healthiest possible ever condition of borrowing money. Businesses can borrow money with ease. It's a healthy borrowing cycle. There's no issues. The further negative this number goes in the equation means businesses have a hard time borrowing. They have a hard time growing, hard time hiring. They will hire less. Likely earnings are going to be down for them. This is so important because credit expansion in the economy, right? How businesses are borrowing, how businesses are spending can tell us a lot about the future of the economy, therefore maybe potential earnings expectations and returns on portfolios. The current level of -3 in this chart is exuberant relative to even looking at kind of seeing where we came from in the trend of the economy. So all this to say is, from a credit expansion and a labor market standpoint, the cracks or so are not really as visible or as dominant as rather they're perceived to be. Okay, so it's actually a very healthy chart. Oh, the red is confusing. That red means negative. It's not negative. Couldn't change the color of that red right there. So that's okay. Red is positive in this case. We'll dub it as that. But on the notion of debt, right? Alisha and I just came across many clients in a relatively small event where the notion of debt was a really big discussion topic. Predominantly government debt, right? Many are worried about government debt. The deficit data in the month of May revealed more debt. The rolling debt number continues to grow. But how we look at debt, right, without getting into the political discussion of debt, some of the data that was released and updated actually over the past month through the end of the year, this stuff takes a long time to update in an aggregate scheme, is generally talking about household debt relative to government debt, right? It's not the same thing, and household debt relative to GDP. Alisha, maybe walk us through a little bit. Why is this chart so significant, not only in its absolute level, but also in its trend line relative to the previous 20, 30 years?
So the relevance of this chart is really that decline, right? Where it peaked, household debt levels peaked around the great financial crisis and has been trending lower since. Why that's important is because households are in much better financial footing than they were prior to the great financial crisis. And that's important, right? Because if they're in better footing going into the next recession, whenever it may be, right? It could be next month, it could be a year from now, 2 years from now. If they're in a better place, the likelihood of that recession being nearly as deep as the great financial crisis is minimal, right? And so when we think about the consumer and at their ability to really have good financial statements, we can kind of extrapolate this into earnings, right? And so we just finished the first quarter earnings cycle, and what we saw was that companies had significantly better earnings than what was anticipated. And so I think we can expect that to go forward as long as the labor market remains in relatively good footing and consumers continue to spend.
I love that. Yeah, it was something like 12.7% was the earnings growth rate in the prior quarter in the S&P 500. Mm-hmm. By the way, that number is about 10% higher than any next analyst ever expected it. So Alisha and I do not make capital market assumptions. We're not going to play the flip the coin game in earnings. Certainly, that was a huge, huge benefit to earnings. One thing to note, when the next recession comes, Alisha noted that it's coming. Absolutely, it's coming. We don't know when. I think hiding behind that is futile. There's no reason to do it, right? The downtrend here in this particular chart does showcase the ability for the economy to be better off as a result of that. So we're not coming from an uptrend to a recession. We'd likely to go from a downtrend into whatever that transpires in the future, we're ready for it, right? One of the things that is driving that current rhetoric is just tracking inflation, right? The inflation discussions that are taking place right now as a result of what's happening with oil prices and food prices in general that are higher is spurring the ability for how long can this continue from an earnings standpoint. And what you're seeing on your chart here, that yellow line, that's the that's the headline consumer price index, or CPI, that came in at 3.8% year-over-year increase in inflation. And that white line is that core CPI. And all that is it's the same number minus energy and food costs. So, Alisha, that 3.8 to 2.8 differential, right? Core versus headline. As we look at this, as we assess this in the Investment Policy Committee on a 5-year forward basis, walk us through where that stands today, because the reality is going to be a lot more welcoming to as an investor rather than maybe as a sentiment indicator.
Yeah, so when we look at that spread, that 1% spread between core and headline, it is rather significant, but the vast majority of that spread is due to the increase in oil prices, right? And what's going on from a geopolitical perspective. When we think about the eventual easing of those geopolitical tensions, what you're likely to see then is the price of oil revert back to where it was prior, or at least start to decline. That is actually going to allow that yellow line to kind of peak and then come down, which is really important. When we think about the spread here, it really is more of an energy related issue. And the white line, really the core, that is the inflation target that the Fed is focused on. So what we'd really like to see here is that to start to creep back to that 2% over the long term as well, which inflation expectations have been holding pretty steady on the long end. And so we're still really focused on what those expectations are for the long end, but that's the one that the Fed is really driving monetary policy based off of, not necessarily the headline.
Yeah, great point. There's been a lot of discussion, should the Fed increase that 2% rate? Not for us to decide, certainly something that may transpire. One of the things that, to simply add to that, when we look at the five-year expectations, that's simply a fancy term of saying, what does the market and investors think inflation will be 5 years from now? Those numbers are actually below the 2.5% mark. And that's actually very, very important as it relates to asset allocation, okay? Now, Energy in general, how has energy impacted all the pricing that we're seeing? Without turning into geopolitical flipping of the coin of what's likely to happen with the Iran truce, I had to dig deep in the archives to build this chart here because it's an indirect exposure of what's likely happening with the Iran truce potential. And what you're seeing on your screen here is Middle East oil production, predominantly from Saudi Arabia, white line, Iran, that blue line, and Iraq, that, what is that, a violet or purple line there. And the bottoming may have actually occurred as early as maybe about a month ago. This data here represents oil production in barrels per day. It's in the thousands, right? So you have to multiply everything by 1,000 to get to the actual data here showing there on the y-axis. But the reality is we are starting to see not only more ships flow through the strait, but each and every time there is a potential announcement for a truce, we're seeing a direct impact oil prices, okay? Meaning oil is likely to react significantly faster than the eventual output that's going to come from the Middle East, from the shipping lanes actually opening back up. That's very positive because we're already seeing oil down 15, 20% from the peak here in the month of May. That has been reflected at the pumps. And certainly it's one of the things we'll be paying close attention to as we're taking advantage of these dislocations in the market. As always, thanks for watching. We're keeping an eye on all things risk management and capital markets and stand ready to take advantage of all future dislocations as we progress over the next 12 months.